There is a moment in global finance when the world seems perfectly calm, when screens glow green, when volatility rests at the bottom of its range, when policymakers insist that conditions remain orderly. Yet beneath that veneer of calm, something else is happening, something subtle, something slow, something that leaves no trace until it is too late. A quiet tightening begins, not in New York, not in Washington, not in the financial centers that the public imagines control the dollar. Instead, it begins far from the spotlight, in banks the headlines never mention, inside offshore balance sheets that do not report what they fear, and within liquidity corridors that never inform the world before they shut. If you stand close enough to the machinery, you can hear it, a faint metallic tension, like a cable pulled 1 inch too far. A dollar shortage does not appear with a bang. It arrives with a whisper, long before the dollar spike ever hits the charts. And the uncomfortable truth is this: the first signs of global stress never reveal themselves in the United States. They begin abroad, inside balance sheets denominated in a currency they cannot print, among institutions forced to borrow dollars in order to survive each business day. These banks feel the strain before anyone else, because they have no central bank standing behind them, only markets, only swap lines, only whatever collateral they can find in a world that always demands more. Most people think the dollar tightens when the Federal Reserve wants it to, but insiders know better. The dollar tightens when the offshore system begins to break, when cross-border lenders reassess risk, when hidden margin calls begin rolling across time zones, when demand for dollar funding surges without warning. This tightening is not a policy choice. It is a structural reaction, encoded inside the design of a global dollar network that grew too large, too fast, and far beyond the Fed's reach. And once this reaction starts, it moves like pressure through a pipeline, silent, automatic, and merciless. Picture this moment as it actually unfolds. A dealer in Hong Kong quietly raises haircuts on dollar collateral because U.S. Treasuries have become just a bit harder to source. A European bank reduces its FX swap rollover because its risk team senses a discrepancy in cross-currency basis signals. A Singapore institution panics when its overnight dollar borrow fails to clear, forcing it to draw on an expensive backup line. No press conference announces these shifts. No market commentator notices them. Yet every one of these small kitten adjustments tightens the global dollar noose another inch, not because someone wants it, but because the system is built to transmit stress outward before anyone can stop it. You were never supposed to see this moment. The offshore dollar system was designed to operate silently, to supply dollar liquidity everywhere without ever revealing how fragile that supply chain has become. But in this video, we are going to open the file rarely discussed, the one that explains why global banks feel the tightening first, why the U.S. barely notices until the damage is done, and why the mechanism behind it remains one of the most misunderstood pillars of international finance. Stay with this story until the end, because once you understand where tightening begins, you'll never look at a dollar spike the same way again. For most of the world, the tightening of the dollar seems like a puzzle with no clear beginning, as if global currency stress simply appears out of thin air, sparked by a headline or a sudden move in yields. But the real story begins decades earlier, in a place most people never think to look: the offshore dollar markets that emerged after World War II, long before the Federal Reserve understood what they would eventually become. To understand why the dollar tightens abroad, first you have to go back to the era when global growth was rebuilding from rubble. When European banks needed dollars but could not access them through traditional channels, and when a new kind of banking system began to form in the shadows. The modern dollar world was not designed, it was improvised. In the 1950s and 1960s, European financial institutions realized they could hold and lend dollars outside the United States without being bound by U.S. regulations or reserve requirements. American companies operating abroad needed offshore dollar deposits. Soviet bloc nations worried the U.S. might freeze their funds, deliberately placed their dollars in European banks. London, freed from the constraints of the British pound's post-war controls, became the natural hub. And slowly, without any official proclamation, without any treaty or institutional blessing, the eurodollar market was born. It is impossible to overstate how transformational this was. The United States controlled the supply of base dollars, physical currency, and bank reserves. But offshore banks operating in London, Zurich, Luxembourg, Singapore, and eventually Hong Kong controlled something far more dangerous and flexible: synthetic dollars created through lending, rehypothecation, and cross-border balance sheet expansion. These dollars were not printed by the Fed. They were created by banks who issued liabilities denominated in dollars and simultaneously acquired dollar assets, everything from loans to corporate paper to U.S. Treasuries. In effect, they manufactured dollar liquidity out of credit, backed not by reserves but by the promise that dollar funding would always be available. For a while, this worked beautifully. Offshore banks expanded credit more freely than their U.S. counterparts, fueling global trade, international investment, and cross-border finance. The entire post-war expansion, from European reconstruction to Asian industrialization, was built on this invisible scaffolding of offshore dollar credit. But at the core of the system was an unspoken assumption: offshore banks would always be able to obtain dollar funding when they needed it. And because they believed this, they built balance sheets that depended on it. The first cracks appeared in the late 1960s, when the convertibility of dollars into gold began to erode. Foreign central banks, especially in Europe, began redeeming their dollar reserves for gold as they realized the U.S. had issued far more dollar claims than it could honor. This dynamic created a strange mirror image. Even as the official gold window strained under excess claims, the offshore dollar system kept expanding, creating even more synthetic dollars that the U.S. could not possibly backstop. By 1971, the imbalance forced President Nixon to close the gold window entirely. But the offshore dollar system survived the shock. In fact, it grew faster. This is where the great misunderstanding begins. Most observers think that dollar's dominance is secured because the U.S. economy is strong, or because the Fed sets interest rates for the world. But in truth, the dollar became dominant because the offshore system grew so large that global finance could not function without it. By the 1980s, the eurodollar engine had reached escape velocity. International loans, commodity trade, cross-border lending, and institutional investment all required offshore dollar channels. And behind each transaction sat a balance sheet that needed to borrow, roll, and refinance dollar liabilities every single day. This constant need to roll dollar funding is where fragility took root. Domestic U.S. banks could turn to the Federal Reserve during crises. Offshore banks could not. Their only safety nets were the private markets, FX swaps, cross-currency basis trades, unsecured dollar lending desks, repo markets, and interbank credit lines. If any of these channels tightened, offshore banks had no choice but to shrink their balance sheets instantly. And when they shrank, they transmitted scarcity through the entire system. This became painfully visible in the 1980s Latin American debt crisis. Offshore banks had lent aggressively to emerging markets, using dollar liabilities to fund long-term loans. When global rates rose and risk sentiment shifted, these banks found themselves unable to roll funding. A silent tightening began abroad, not in the U.S., and within months, the pressure cascaded into a crisis. The pattern repeated again in the 1990s during the Asian financial crisis. Korean, Thai, Indonesian, and Malaysian financial institutions were heavily reliant on short-term offshore dollar borrowing to fund long-term investments. When offshore lenders pulled back, the USD funding channels seized, currencies collapsed, and the tightening spread outward like a shockwave. But the world did not learn the lesson. Instead, the offshore dollar system grew even larger. By the early 2000s, global banks had integrated offshore USD funding into their core business models. European banks, in particular, built massive US dollar books. They borrowed dollars through FX swaps and short-term money markets, then used those dollars to buy U.S. mortgage-backed securities and treasuries. These banks were not regulated by the Fed. They had no access to U.S. dollar reserves, and yet they held trillions of dollars in USD assets that required continuous funding. The entire European banking system became a leveraged extension of the American credit market, but without the safety mechanisms. American banks had. That hidden mismatch detonated in 2008. When U.S. housing weakened, offshore banks still needed to fund their dollar assets. But dollar lenders no longer trusted anyone holding mortgage exposure. FX swap spreads blew out. The cross-currency basis plunged. Offshore dollar funding evaporated. And just like in every crisis before, the tightening began outside the United States. Korean banks failed to roll FX swaps. European banks scrambled for dollars. Japanese corporates hoarded dollar liquidity. Even before U.S. markets froze, the offshore system was already suffocating. The Federal Reserve eventually intervened with swap lines, emergency channels that allowed foreign central banks to borrow dollars and distribute them to local banks. But the damage had already been done. The world saw for the first time the true architecture of the hidden dollar system, its size, its dependence on continuous offshore liquidity, and its vulnerability to sudden, silent tightening. Yet even after the crisis, the world returned to the same structure. Offshore banks continued to rely on dollar funding because global trade, commodity invoicing, corporate debt issuance, and institutional portfolios all demanded dollars. Emerging markets kept borrowing in dollars because local currencies were too small to support deep credit markets. Asian banks kept expanding USD-denominated assets. European banks rebuilt their cross-currency swap channels. The offshore dollar remained the backbone of global finance. And that brings us to the mechanism at the heart of this video: offshore margin call transmission. Most people imagine margin calls as a single event, something that happens when an investor's equity falls below a threshold. But in the offshore dollar world, margin calls behave differently. They move cross-border. They propagate through funding chains. They trigger adjustments in FX swap pricing, treasury collateral requirements, and risk-weighted asset calculations. A margin call in Hong Kong can force a balance sheet adjustment in Zurich, which can tighten USD lending in Singapore, which can raise haircuts for institutions in Brazil, which then feed back into global funding markets. This is the mechanism that makes the dollar tighten abroad first. Offshore banks feel the funding strain before the U.S. even notices. Because they operate at the end of the liquidity pipeline using a currency they cannot print to support assets they must fund daily. Every historical episode reinforces the same truth. The dollar does not tighten when the Fed wants it to. The dollar tightens when offshore banks reach the limits of their balance sheets, when global institutions cannot roll funding at scale, and when hidden margin calls begin transmitting through FX swap corridors like whispers of an approaching storm. From Latin America to Asia, from Europe to emerging markets, the pattern has remained the same for nearly 50 years. And yet, despite this long history, despite repeated crises and countless warning signs, the official narrative still pretends the dollar system is governed by domestic U.S. policy alone. Central banks speak as if they control global liquidity with interest rates. Economists write as if the offshore dollar market is just a secondary detail. Headlines frame dollar spikes as reactions to economic news or geopolitical tensions, but the insiders know better. They know the first tightening always begins offshore, in institutions dependent on cross-border dollar funding, with no lender of last resort behind them. They know the mechanism is structural, not discretionary. They know the world runs on a fragile network of synthetic dollars that reacts instantly to changes in collateral, basis spreads, risk appetite, and margin requirements. And they know that once offshore dollar funding begins to dry, it is already too late for the rest of the world to avoid the consequences. This is the setup, the origin story, the unspoken architecture, the historical blueprint for the system we live in today. In the next part of this video, we will confront the moment the system pivots. The modern twist that reveals why dollar stress still emerges abroad before anyone in the US feels a thing. Because once you understand that moment, you will understand the secret the global financial system never wanted to make obvious. The dollar belongs to the United States, but the dollar shortage belongs to the world. The moment the system changes never announces itself. There is no siren, no headline, no dramatic flash that tells the world a tightening has already begun. Instead, the shift emerges from something almost invisible. A basis point move in cross-currency swaps that looks trivial to the untrained eye. A small adjustment in margin requirements at an offshore prime desk, a slight hesitation in overnight lending that traders dismiss as routine. Yet somewhere inside these subtle changes, the pressure flips direction. The offshore dollar network, which normally absorbs global liquidity demand, suddenly begins rejecting it. And when that pivot happens, the tightening abroad becomes irreversible. The twist is this. The modern dollar system no longer tightens because of credit risk. It tightens because of collateral mechanics. The vulnerability today is not about banks fearing default. It is about their inability to fund the balance sheets they built on the assumption of seamless dollar access. In an era where global institutions rely on FX swaps to transform local currency into dollars, even a tiny change in the cross-currency basis can trigger massive balance sheet stress. When the basis widens, the synthetic dollar becomes more expensive. When it widens sharply, the synthetic dollar becomes impossible. This is the point where offshore margin call transmission begins. Imagine a European bank that funds its US dollar assets through short-term FX swaps. When the basis widens, its funding costs rise. A risk officer notices the spread shift and demands additional balance sheet buffers. Treasury responds by requiring more collateral for internal transfers. A trading desk that depends on this liquidity suddenly faces tighter limits. It begins trimming positions small at first, then faster, then indiscriminately as risk cascades through departments. None of these decisions appear in any public disclosure. Yet, with each internal adjustment, the global dollar tightens another notch. But the real twist emerges when you follow how this tightening spreads. In Hong Kong, a bank that relies on the same FX swap markets to borrow dollars notices the shift hours earlier due to time zone differences. It increases its collateral requirements for clients seeking USD funding. A corporate borrower attempting to roll short-term debt finds the rate suddenly higher than expected. That borrower draws down credit lines instead. The bank responds by hoarding liquidity. Overnight markets react, and before London or New York even opens, Asia has already transmitted the stress forward. This propagation is not theoretical. It is mechanical. When collateral haircuts rise offshore, banks must either post more collateral or shrink their balance sheets. Shrinking balance sheets means fewer dollar loans. Fewer dollar loans means higher global demand for alternative dollar sources. That demand pushes the cross-currency basis wider. A wider basis raises synthetic dollar costs for every institution using FX swaps. Higher synthetic costs trigger more internal risk adjustments, and each adjustment tightens the system again. It is a self-reinforcing loop, a tightening spiral that does not need news, panic, or crisis to begin. It only needs a slight shift in the hidden cost of dollar funding. And this is where the most uncomfortable truth emerges. The Federal Reserve is not the first line of defense against global dollar stress. It is the last. The offshore system does not reach out to the Fed until the damage is severe. Instead, it reacts internally, silently, mechanically. The tightening spreads through private balance sheets long before any policymaker understands what is happening. By the time swap lines are activated or emergency measures are announced, the offshore system has already inflicted pain across multiple continents. This lag between cause and recognition is the reason crises seem sudden to the public. When the dollar surges violently on charts, when emerging markets sell off. when analysts start talking about risk-off flows, the tightening abroad has already been underway for weeks. The world notices only the aftermath, not the beginning. The twist, then, is not simply that the dollar tightens abroad first. It is that the offshore system decides when the tightening begins. The mechanism is not controlled by policymakers, but by the reactions of thousands of institutions managing trillions of dollars of assets and liabilities, each forced to defend its balance sheet before defending the global system. Margin calls are not events, they are waves. They move across time zones, across funding markets, across internal risk dashboards. And once those waves begin rolling, they converge into something larger, something structural, a global dollar squeeze that no single institution can stop. This is the part most explanations miss. They look for a narrative trigger: news, policy changes, geopolitical shocks, when the real trigger is embedded in the system itself. It is the structure of offshore USD funding that creates the stress, not the story. The basis widens, the funding costs rise, the collateral demands tighten, and suddenly, a global economy built on borrowed dollars discovers that the supply of those dollars is not as elastic as it once believed. You were never supposed to see this pivot, but once you do, everything about global finance looks different. To understand why the dollar tightens abroad, first, you must enter the machinery that never appears in textbooks, the offshore balance sheets that expand and contract based on funding channels, margin requirements, and cross-currency dynamics that the public almost never sees. This part of the story is not about narrative. It is about architecture. A global network of institutions, banks, dealers, insurers, shadow lenders, export credit agencies, sovereign funds preys on a shared assumption that dollars can always be borrowed, swapped, or collateralized at a reasonable cost. The moment that assumption weakens, the entire structure vibrates. The mechanism at the center of this video, offshore margin call transmission through cross-border USD funding, channels, is the silent engine behind nearly every modern dollar stress cycle. It is not dramatic, it is not obvious, but it is relentless. It shapes how dollars move from one continent to another, how financial institutions decide whether to lend or withdraw liquidity, and how prices around the world respond even before the US feels the slightest ripple. Once this mechanism activates, the tightening becomes global long before policymakers or even markets can process what is happening. To see how this machinery operates, you must start with the essential fact most people overlook. Offshore banks hold trillions of dollars in USD assets without holding USD reserves. The BIS estimated that by 2023, non-US banks held over $15 trillion in dollar-denominated liabilities, dollars they owed to someone else, dollars that had to be rolled, refinanced, or collateralized. But these banks do not have access to the Federal Reserve's balance sheet. They cannot borrow from the Fed. They cannot create reserves. Their only access to dollars comes from private markets, FX swaps, repo desks, unsecured interbank loans, or swap lines intermediated through their own central banks. Everything depends on these channels staying open, and they do not always stay open. The vulnerability begins with the mismatch embedded in cross-currency funding. When a European, Asian, or Latin American bank needs dollars, it often enters into an FX swap exchanging local currency for dollars today, with an agreement to reverse the trade at a future date. But the cost of this swap is not fixed. It fluctuates based on supply, demand, geopolitical tension, interest rate differentials, and perceived risk. When demand for dollars rises, the cross-currency basis widens. A wider basis means synthetic dollars become more expensive. When synthetic dollars become more expensive, offshore balance sheets tighten automatically. And this is where margin calls begin creeping through the system. Banks treat FX swaps as collateralized funding instruments. They require counterparties to post margin when prices move against them. If the basis widens, a bank receiving synthetic dollars must post more collateral. If the value of that collateral declines, such as when Treasury yields rise and bond prices fall, the bank must post even more. And because these margin calls occur across thousands of institutions simultaneously, the pressure compounds across borders. A margin call in Tokyo can force a liquidity pullback in Frankfurt, which can reduce lending in São Paulo, which can tighten USD availability in Johannesburg, all before New York wakes up. This chain reaction is not theoretical. It is encoded in the math. Consider a European bank holding $50 billion in U.S. mortgage-backed securities funded through short-term FX swaps. If the cross-currency basis shifts from -10 basis points to -40, the bank's funding cost rises sharply. Its Treasury Department recalculates the cost of rolling its book and demands more high-quality collateral to cover the potential loss. The bank's risk team, noticing the shift, raises haircuts internally. Those higher haircuts make it more expensive for the bank's trading desks to finance their own dollar assets. The trading desks respond by trimming positions or refusing to take on new ones. That reduction tightens the market just slightly, but that slight tightening is all it takes to push the basis even wider. Now imagine this happening across every major offshore bank. The tightening accelerates not because demand for dollars has suddenly spiked, but because the cost of transforming local currency into dollars has risen. This transformation process is foundational. The world runs on it. Asian corporates issuing USD debt depend on it. European banks buying US treasuries depend on it. Global trade financed in dollars depends on it. When the basis moves, everything moves. And the basis almost always moves offshore first. FX swaps are primarily priced in Asia during their own trading hours, then adjusted in Europe, then finalized in the US, but because most synthetic dollar borrowers are concentrated outside the US, the earliest stress signals originate outside the US too. If a Korean bank faces higher swap costs overnight, it adjusts collateral requirements for corporate clients by morning. Those clients trying to roll their dollar obligations suddenly face higher costs. They draw down backup lines. Banks respond by hoarding liquidity. The hoarding reduces interbank lending. Rates rise. The basis widens again, and the tightening spreads. To see just how fragile this system is, consider what happened during the 2011 Eurozone sovereign debt crisis. European banks held massive USD asset books mortgage-backed securities, US corporate loans, repos. Their dollar liabilities were rolled through short-term FX swaps. When markets began doubting the stability of European sovereigns, offshore dollar lenders pulled back. FX swap costs surged. European banks faced margin calls not because their underlying assets had failed, but because funding structures had shifted. The BIS later reported that European banks had over $2.7 trillion in short-term USD funding needs at the time, far more than they could secure when the crisis deepened. Dollar stress emerged in Europe months before policymakers realized how severe the problem was. The same pattern appeared in 2014-2015 when the dollar strengthened sharply. Many believe the movement was due to expectations of Fed tightening. But the cross-currency basis signaled something else. Offshore banks were struggling to roll USD funding. Japanese banks, among the largest holders of US dollar assets, faced rising swap costs that eroded profitability. Their internal models raised red flags. They demanded more collateral from clients. Those clients scrambled for dollars. And once again, tightening began outside the US long before the domestic banking system showed any signs of strain. Perhaps the clearest demonstration came in March 2020, when the world entered pandemic lockdown. Before US markets experienced their dramatic liquidity freeze, the offshore dollar system had already fractured. Singaporean banks could not roll swaps. Korean banks activated emergency USD liquidity tools. European banks saw cross-currency swap spreads blow out to levels not seen since 2008. Emerging markets faced an immediate run on their FX reserves as dollar obligations came due. Across the world, central banks were forced to intervene. Only after offshore dollar stress reached critical levels did the Federal Reserve open unlimited swap lines with major central banks. And even then, offshore dollar demand took weeks to stabilize. These historical patterns reveal the truth. The global dollar system tightens when offshore synthetic dollar creation fails, not when the Fed raises rates. And that failure always begins with collateral mechanics. Collateral is the hidden language of the global dollar system. It determines who gets funding, how much, at what cost, and for how long. When collateral values fall within by a small amount, offshore institutions face immediate funding pressure. If U.S. Treasuries decline in price, the collateral they post for FX swaps becomes less valuable. They must post more to compensate. But because many of these banks fund long-term assets with short-term swaps, they often do not have enough collateral on hand. Their only choice is to shrink their balance sheets. Balance sheet shrinkage transmits the tightening. A bank that cannot post enough collateral reduces lending. Reduced lending forces clients to find dollars elsewhere. Those clients enter the FX swap market or draw on credit lines. This increases demand for synthetic dollars. Increased demand widens the basis further, and the cycle repeats. Every step of this cycle tightens the dollar abroad before the U.S. feels anything. This is why crises often appear asymmetric. During the Asian financial crisis, Korean, Thai, and Indonesian banks suffered intense pressure even though the U.S. economy was stable. They had borrowed heavily in dollars because local markets lacked depth. When lenders pulled back, those nations experienced immediate currency collapses. Their tightening had nothing to do with U.S. interest rates. It emerged from an offshore structure that had no safety valves. During the taper tantrum of 2013, emerging markets faced violent outflows, currency depreciation, and liquidity shortage, even though U.S. markets experienced only mild volatility. Again, the tightening occurred offshore first. But the most misunderstood aspect of offshore margin call transmission is that it affects treasury markets too. Many offshore banks use treasuries as collateral for FX swaps. Treasury liquidity declines as it did in March 2020. Swap spreads widen, making synthetic dollar funding even more expensive. This dynamic creates a feedback loop. Dollar stress reduces demand for treasuries. Lower treasury liquidity raises haircuts, and higher haircuts intensify offshore margin calls. In the U.S., the Fed can intervene. Abroad, no one can. This is where the true fragility lies. The offshore dollar system is extremely large, extremely interconnected, and extremely dependent on collateral-based funding structures. It reacts automatically to changes in basis spreads, treasury yields, or perceived credit risk. The Fed can act as lender of last resort. Offshore banks cannot. Their liquidity buffers depend not on central banks, but on the behavior of private markets. This explains why offshore tightening precedes U.S. tightening. By the time the U.S. experiences dollar strength, offshore institutions have already been scrambling for weeks. Their basis spreads widened long before us spreads did. Their collateral haircuts increased sooner. Their liquidity constraints emerged earlier. Their internal models detected stress at levels far below public visibility. When you hear analysts say the dollar is rising, it is already the final stage of a process that began in foreign balance sheets. To illustrate how quickly this transmission can occur, consider a simple sequence. A Japanese bank funding $20 billion in U.S. corporate bonds sees the basis shift by 15 basis points. The cost increase triggers a margin call from its FX swap counterparty. The bank posts treasuries as collateral, but those treasuries have lost value due to rising yields. The desk demands more collateral. The bank does not have enough. It shrinks its position. That shrinkage reduces demand for USD assets. Prices adjust. The adjustment spooks other institutions, which update risk models, raising internal haircuts. Those haircuts ripple through Asia. By the time Europe opens, multiple institutions are preserving liquidity. When New York opens, the market looks calm on the surface, but offshore, a tightening wave is already spreading. This is why global crises seem to accelerate once they reach the U.S. The U.S. is not the beginning of the tightening. It is the end point. And the end point always looks violent because all previous adjustments have already compressed balance sheets abroad. The most rigorous studies BIS working papers IMF analyzes, and Fed staff notes converge on the same conclusion. Cross-border USD funding and FX swap markets are the world's largest source of hidden systemic risk. They are also the least regulated, least understood, and least visible to the public. Even sophisticated investors rarely track cross-currency basis movements or offshore swap spreads, but those numbers are the early warning indicators of stress. A widening basis is not a market anomaly, is a margin call in slow motion. These dynamics also explain why dollar stress reappears even without crises. If global trade shifts, if commodity prices rise, if emerging markets issue more USD debt, if European banks expand USD books, if U.S. Treasury issuance surges, offshore demand for dollars increases, but supply does not increase automatically. The Fed supplies reserves domestically, not globally. The offshore system supplies synthetic dollars, not base money. Synthetic dollars depend on collateral. Collateral depends on market prices. When prices fall, synthetic dollar supply contracts. And when synthetic supply contracts, countries' banks, corporates, sovereigns experience a tightening that no policy can instantly reverse. By the time the Fed reacts, lowering rates, opening swap lines, expanding its balance sheet, the offshore system has already transmitted stress through dozens of channels. The tightening began not with a policy misstep, not with a recession call, not with a headline, but with the silent arithmetic of offshore funding costs. This is the hidden truth. The world doesn't run on dollars. It runs on the ability to borrow dollars. And that ability begins failing outside the United States long before domestic markets feel anything. The mechanism offshore margin call transmission explains why every crisis begins abroad. It explains why emerging markets feel pain before advanced economies. It explains why cross-currency basis spreads widen days or weeks before major sell-offs. It explains why dollar liquidity is not evenly distributed, why some regions collapse faster, and why tightening always appears sudden, even though it is structural. The dollar belongs to the United States, but the dollar shortage belongs to the world. If you stand back from the charts, from the swap spreads, from the basis curves, and the collateral mechanics, a darker picture begins to emerge, one that does not fit neatly into the optimistic narratives policymakers prefer to repeat. It is the picture of a global system built on a quiet contradiction. Everyone needs dollars. Yet no one outside the United States can create them. The world has grown dependent on a currency whose supply chain it does not control, and every crisis is a reminder of this imbalance. The offshore dollar engine, vast and silent, sits beneath governments, corporations, banks, and households around the world. And it needs everything to go right, every day, in every time zone, for the system to stay stable. That is the part no one wants to admit. The structure is elegant when the world is calm, when collateral values rise, when liquidity is abundant, when synthetic dollar channels hum along without interruption. But the elegance is deceptive. It hides the unforgiving nature of a system that punishes imbalance instantly. It hides the fact that thousands of institutions are bound together not by cooperation, but by necessity, one reliant on the next to keep the machinery from slowing, when that machinery encounters even the smallest resistance. The tightening begins with the same cold precision every time. Offshore first, domestic last. What makes this tightening so dangerous is not its speed. It is its invisibility. By the time the public sees the dollar spike, the stress has already crossed continents. By the time policymakers acknowledge the shortage, offshore banks have already sold assets, raised haircuts, and cut lending. By the time headlines mention disruption, the system has already transmitted margin calls across dozens of balance sheets. Crises do not begin with panic. They begin with arithmetic. And the arithmetic is ruthless. A 1% move in Treasury yields can vaporize billions in collateral value. A 20 basis point shift in the cross-currency basis can erase the profitability of an entire dollar book. A misunderstanding of risk at one institution can trigger a liquidity freeze at another, half a world away. These are not events. They are mechanisms, predictable, repeatable, embedded, and they will not disappear simply because the world wishes for a more balanced monetary system. The hidden dollar network is too large, too entrenched, too deeply woven into global finance to unwind smoothly. That is why this tightening will happen again. It will happen when global growth weakens and demand for dollars rises. It will happen when Treasury liquidity thins and collateral haircuts climb. It will happen when geopolitical stress pushes investors toward safety. It will happen when emerging markets borrow more dollars than they can roll. It will happen when banks expand USD books in good times and discover, too late, that funding assumptions have changed. And it will happen silently, the way it always has. Not in the United States. Not where the Federal Reserve can see it, but abroad in balance sheets that depend on synthetic dollars, collateral valuations, and perfect conditions that the real world cannot consistently provide. There is a deeper lesson here, one that is uncomfortable but necessary. The world has built its financial architecture on an illusion of elasticity, the belief that dollars are always available, that markets will always clear, that funding will always roll. But elasticity is not the same as resilience. Elasticity stretches until it snaps. Resilience absorbs shocks. The offshore dollar system has elasticity in abundance, but almost no resilience. When the stretch becomes too great, it recoils violently. That recoil is the tightening we have explored. It is the hidden margin call that moves across borders before the world notices. And the next time it comes in, the initial signs will again be visible only to those watching the basis curves. The collateral chains, the offshore swap spreads that whisper long before anything breaks.